Hello friends, good morning, good afternoon, good evening, whenever you're watching or listening to my channel NSR Audiobooks. Welcome back to my channel. Let's roll up to next topic. In The Psychology of Money, Morgan Housel discusses several cognitive biases that influence financial decision-making. Here are some of these biases explained. Loss aversion. People tend to strongly prefer avoiding losses over acquiring gains of equal value. This bias can lead to conservative investment decisions or holding on to losing investments for too long, hoping they will rebound. Recency bias. This bias involves giving more weight to recent events or information while discounting older data. In the context of finance, this can lead to overreacting to short-term market fluctuations rather than focusing on long-term trends. Confirmation bias. This bias involves seeking out information that confirms pre-existing beliefs or opinions while ignoring contradictory evidence. In investing, this can lead to overlooking red flags about an investment because one is focused only on information that supports their initial decision. Anchoring. This bias occurs when individuals rely too heavily on the first piece of information they receive, the anchor, when making decisions. For example, investors may anchor their expectations for a stock's performance based on its initial purchase price, even if the market conditions have changed significantly. Overconfidence bias. This bias involves an inflated belief in one's own abilities, knowledge, or judgments. In finance, overconfident investors may take excessive risks or trade too frequently, believing they can outperform the market consistently. Herd mentality. This bias involves following the actions or decisions of the majority, often without questioning or independently analyzing the information. In investing, herd mentality can lead to bubbles or crashes as investors collectively rush into or out of assets based on popular sentiment rather than fundamentals. Endowment effect. This bias occurs when individuals value something they already own more than they would if they did not possess it. This can lead to reluctance to sell investments even when it's financially prudent to do so, due to an emotional attachment to the asset. Availability heuristic. This bias involves making judgments or decisions based on information that is readily available or easily recalled. For example, investors may overestimate the likelihood of certain events, like market crashes, if those events are highly publicized or memorable. Loss aversion, a concept extensively discussed in The Psychology of Money, refers to the tendency of individuals to strongly prefer avoiding losses over acquiring gains of equal value. Morgan Housel elaborates on this concept by highlighting how it influences financial decision-making in various ways. Risk aversion. Loss aversion often leads to risk aversion, where individuals are more reluctant to take risks that could result in losses, even if the potential gains are substantial. This mindset can lead to overly conservative investment strategies, such as favoring low-risk, low-return investments over higher-risk, potentially higher-return opportunities. Sunk cost fallacy. The book discusses how loss aversion contributes to the sunk cost fallacy, where individuals continue to invest time, money, or effort into a failing endeavor simply because they've already invested heavily in it. They are averse to losing what they've invested, even if cutting their losses and moving on would be the more rational choice. Investment holding bias. Loss aversion can also lead to an investment holding bias, where individuals hold on to losing investments for too long, hoping that they will eventually recover and avoid realizing the loss. This behavior can prevent investors from reallocating their resources to more promising opportunities. Emotional impact. Housel discusses the emotional impact of losses compared to gains, noting that losses have a more significant psychological impact than equivalent gains. This asymmetry can lead to irrational decision-making, as individuals may go to great lengths to avoid losses, even if it means missing out on potential gains. Long-term consequences. Loss aversion can have long-term consequences on financial well-being, as individuals may prioritize avoiding short-term losses over long-term growth and wealth accumulation. This mindset can hinder wealth-building strategies that require taking calculated risks and staying invested through market fluctuations. By understanding the impact of loss aversion on financial decision-making, individuals can work towards mitigating its effects. This may involve developing a more balanced approach to risk, focusing on long-term goals rather than short-term fluctuations, and being willing to reassess and adjust investment strategies when necessary, even if it means accepting temporary losses. Recency bias. As discussed in The Psychology of Money, refers to the tendency of individuals to give more weight to recent events or information while discounting older data. Morgan Housel elaborates on this concept in the context of financial decision-making. Market fluctuations. Recency bias can lead investors to overreact to short-term market fluctuations. For example, if the stock market experiences a sharp decline over a few days, individuals influenced by recency bias may panic sell their investments, fearing further losses, without considering the long-term prospects of their investments. Performance evaluation. The book discusses how recency bias affects how people evaluate investment performance. Investors may place undue importance on recent positive or negative returns, extrapolating short-term trends into long-term expectations. This can lead to unrealistic expectations or overly pessimistic reactions based on recent performance alone. Media influence. Recency bias is often amplified by media coverage of financial news and events. Housel points out how sensationalized reporting of recent market movements or economic indicators can sway investor sentiment, leading to herd behavior and exaggerated market reactions. Decision-making. In terms of decision-making, recency bias can cause individuals to make impulsive or reactive financial decisions based on recent experiences rather than a comprehensive analysis of the broader economic and market context. This can lead to suboptimal investment choices and missed opportunities. Long-term perspective. Housel emphasizes the importance of maintaining a long-term perspective and avoiding the pitfalls of recency bias. Investors who focus too much on short-term fluctuations may overlook the fundamental value of their investments or fail to stay disciplined during market volatility. Overall, understanding recency bias helps investors become more aware of their tendencies to overemphasize recent events in their financial decision-making process. By maintaining a balanced approach, considering historical data, and focusing on long-term goals, individuals can mitigate the negative impact of recency bias on their investment strategies. Confirmation bias, as discussed in The Psychology of Money, refers to the tendency of individuals to seek out information that confirms their pre-existing beliefs or opinions while ignoring or discounting contradictory evidence. Morgan Housel explores this concept in the context of financial decision-making. Information filtering. Confirmation bias leads people to selectively filter information that aligns with their existing views on investments, markets, or economic conditions. For example, an investor who believes a certain stock will perform well may only seek out positive news or analysis about that stock, disregarding any negative factors. Reinforcement of beliefs. Housel discusses how confirmation bias reinforces existing beliefs or biases, making it challenging for individuals to objectively evaluate new information or alternative viewpoints. This can result in a closed-minded approach to financial decision-making, limiting the ability to consider diverse perspectives or potential risks. Overlooking contradictory evidence. Investors influenced by confirmation bias tend to overlook contradictory evidence or downplay its significance. This can lead to a false sense of confidence in investment decisions, as individuals may only focus on information that supports their initial beliefs while ignoring red flags or warning signs. Selective memory. The book highlights how confirmation bias can influence memory recall, with individuals more likely to remember information that confirms their beliefs and conveniently forget or dismiss information that challenges them. This can contribute to overestimating past successes or underestimating past mistakes, distorting one's perception of investment performance. Echo chambers. Housel discusses how confirmation bias contributes to the creation of echo chambers, where individuals surround themselves with like-minded people or sources of information that reinforce their beliefs. This can lead to groupthink and herd behavior in financial markets, as individuals validate each other's biases rather than critically evaluating information. By understanding confirmation bias, investors can strive to mitigate its impact on their decision-making process. This may involve actively seeking out diverse perspectives, challenging assumptions, conducting thorough research that considers multiple viewpoints, and being open to revising beliefs in light of new information. Overcoming confirmation bias can lead to more informed and objective financial decisions. Anchoring, as discussed in The Psychology of Money, refers to the cognitive bias where individuals rely too heavily on the first piece of information they receive, the anchor, when making decisions, even when that information may not be relevant or accurate. Morgan Housel explores this concept in the context of financial decision-making. Initial reference point. Housel explains how anchoring influences investors by providing an initial reference point from which they make subsequent judgments or decisions. For example, if an investor hears a stock price mentioned as the anchor point, they may unconsciously compare all future price movements and decisions based on that initial price. Biased decision-making. The book highlights how anchoring can lead to biased decision-making, as individuals may fixate on the anchor point and fail to adjust their assessments based on new information or changing circumstances. This can result in suboptimal investment choices or unrealistic expectations about market performance. Price anchors. In the context of stock investing, anchoring often occurs with price anchors, such as the purchase price of a stock or a historical high/low price. Investors may be reluctant to sell a stock below their purchase price, anchored at a loss, or may set unrealistic price targets based on historical peaks, anchored at a high. Psychological impact. Housel discusses the psychological impact of anchoring, noting that once an anchor is established, it can be challenging for individuals to deviate from that reference point. This can lead to emotional attachment to certain prices or outcomes, influencing decision-making beyond rational analysis. Influence of external factors. The book also explores how external factors, such as media reports or market commentary, can serve as anchors and influence investor perceptions and behavior. Anchors set by influential figures or popular narratives can shape market sentiment and drive collective actions among investors. By understanding anchoring bias, investors can take steps to mitigate its impact on their decision-making process. This may involve consciously questioning and re-evaluating initial reference points, considering a range of factors beyond the anchor, and avoiding making decisions based solely on the anchoring effect. Developing awareness of anchoring bias can lead to more rational and adaptive financial decisions. In The Psychology of Money, overconfidence bias is discussed as a cognitive bias where individuals tend to have an inflated belief in their own abilities, knowledge, or judgments. Morgan Housel explores this concept in the context of financial decision-making. Investment decisions. Overconfidence bias can lead investors to overestimate their skills and knowledge when making investment decisions. They may believe they can consistently outperform the market or pick winning stocks, leading to excessive risk-taking or trading activity based on unwarranted confidence. Past successes. Housel discusses how past successes can contribute to overconfidence bias, as individuals may attribute their successes solely to skill rather than luck or favorable market conditions. This can lead to a false sense of invincibility and an underestimation of potential risks. Illusion of control. The book highlights how overconfidence bias creates an illusion of control, where individuals believe they have more control over outcomes than they actually do. This can lead to overtrading, market timing attempts, or other behaviors driven by the belief that one can predict or control market movements. Risk assessment. Overconfidence bias can distort risk assessment, with individuals underestimating the probability of negative outcomes or losses. This can lead to inadequate diversification, failure to consider downside risks, and overexposure to risky assets based on an overly optimistic outlook. Confirmation bias reinforcement. Housel discusses how overconfidence bias often reinforces confirmation bias, as individuals may selectively seek out information that confirms their overconfident beliefs while ignoring or discounting contradictory evidence. This can further amplify the risks associated with overconfidence-driven decision-making. Long-term performance. The book emphasizes that overconfidence bias can negatively impact long-term investment performance, as excessive risk-taking or overestimation of abilities can lead to significant losses during market downturns or volatile periods. By understanding overconfidence bias, investors can take steps to mitigate its impact on their financial decisions. This may involve regularly reassessing and validating assumptions, seeking diverse perspectives and feedback, acknowledging the role of luck and external factors in outcomes, and adopting a more humble and cautious approach to investing. Developing self-awareness and humility can help individuals avoid the pitfalls associated with overconfidence bias. In The Psychology of Money, herd mentality is discussed as a cognitive bias where individuals tend to follow the actions or decisions of the majority, often without questioning or independently analyzing the information. Morgan Housel explores this concept in the context of financial decision-making. Behavioral contagion. Herd mentality is described as a form of behavioral contagion, where individuals are influenced by the actions and opinions of others, especially in uncertain or ambiguous situations. This can lead to groupthink and a tendency to conform to popular trends or narratives in the financial markets. Fear of missing out. FOMO. The book highlights how herd mentality is often driven by the fear of missing out, FOMO, on potential gains or opportunities. Investors may feel compelled to follow the crowd, even if they have doubts or reservations, out of a fear of being left behind or losing out on profits. Market bubbles and crashes. Housel discusses how herd mentality contributes to the formation of market bubbles and subsequent crashes. During a bubble, investors rush to buy assets because others are doing so, driving prices to unsustainable levels. Similarly, during a crash, panic selling occurs as investors collectively react to negative sentiment without independent analysis. Information cascades. Herd mentality can lead to information cascades, where individuals base their decisions primarily on the actions of others rather than on fundamental analysis or information. This can create feedback loops in the market, amplifying trends and exaggerating market movements. Contrarian opportunities. The book also highlights the contrarian opportunities that arise from herd mentality. Housel suggests that investors who can resist the urge to follow the crowd and instead take contrarian positions based on independent analysis and a long-term perspective may capitalize on market inefficiencies created by herd behavior. Emotional influences. Herd mentality is often driven by emotional influences such as greed, fear, and social validation. Housel emphasizes the importance of emotional discipline and critical thinking in resisting herd behavior and making rational financial decisions. By understanding herd mentality, investors can become more aware of the potential biases and pitfalls associated with following the crowd. This awareness can help individuals maintain independence in their decision-making, focus on fundamental factors rather than market noise, and potentially exploit opportunities that arise from contrarian viewpoints. The endowment effect, as discussed in The Psychology of Money, refers to the cognitive bias where individuals tend to value something they already own more than they would if they did not possess it. Morgan Housel explores this concept in the context of financial decision-making. Emotional attachment. The book highlights how the endowment effect is often driven by emotional attachment to possessions or investments. When individuals own a particular asset, they develop a sense of ownership and attachment that leads them to value it more highly than they would if they were considering acquiring it anew. Reluctance to sell. The endowment effect can manifest as a reluctance to sell investments or assets, even when doing so would be financially prudent. This reluctance is rooted in the perceived loss aversion associated with giving up something one already possesses, leading individuals to hold on to investments longer than they should. Price discrepancy. Housel discusses how the endowment effect can create a price discrepancy between what individuals are willing to pay to acquire an asset and what they are willing to accept to sell the same asset. This discrepancy can lead to inefficiencies in markets, as buyers and sellers may have divergent valuations based on their ownership status. Status quo bias. The endowment effect is related to the status quo bias, where individuals prefer maintaining their current situation or holdings rather than making changes. This bias contributes to inertia in decision-making, as individuals are hesitant to deviate from the familiar and comfortable, even if doing so could lead to better financial outcomes. Psychological ownership. Housel emphasizes that the endowment effect is rooted in psychological ownership, where individuals perceive ownership of an asset not just as a financial holding but as part of their identity or self-image. This psychological attachment influences how they value and interact with the asset. Impact on decision-making. The book discusses how the endowment effect can impact investment decisions, estate planning, and other financial choices. Recognizing this bias is crucial for investors to avoid becoming overly attached to specific investments or assets, and to make rational decisions based on objective analysis and long-term goals. By understanding the endowment effect, investors can be more mindful of their emotional attachments to assets and make decisions that align with their financial objectives rather than being swayed by biases related to ownership and attachment. The availability heuristic, as discussed in The Psychology of Money, is a cognitive bias where individuals make judgments or decisions based on information that is readily available or easily recalled from memory. Morgan Housel explores this concept in the context of financial decision-making. Vividness of information. The availability heuristic is influenced by the vividness or salience of information. Housel discusses how memorable or emotionally impactful events, such as market crashes or investment success stories, are more likely to be recalled and given greater weight in decision-making, even if they are not statistically representative of typical outcomes. Media influence. The book highlights how media coverage and news reports can shape the availability heuristic. Sensationalized or dramatic news stories about financial events can make them more memorable and accessible in people's minds, leading to biased perceptions and decisions based on the availability of such information. Anchoring effect. The availability heuristic can also interact with other biases, such as the anchoring effect. For example, individuals may anchor their perceptions of market performance or investment opportunities based on recent news headlines or prominent media narratives, leading to biased judgments and actions. Recency bias. Housel discusses how the availability heuristic is related to recency bias, where recent information or events have a disproportionate influence on decision-making. Investors may overreact to recent market movements or news events, disregarding historical data or broader trends due to the availability of immediate information. Risk perception. The availability heuristic can distort risk perception, as individuals may overestimate the likelihood of events or outcomes that are highly publicized or easily recalled from memory. This can lead to exaggerated fears or misplaced confidence in certain investment decisions based on anecdotal evidence rather than comprehensive analysis. Counteracting the bias. The book emphasizes the importance of counteracting the availability heuristic by seeking out diverse sources of information, conducting thorough research, and considering a wide range of factors beyond what is immediately available or memorable. Developing a disciplined and analytical approach to decision-making can help mitigate the impact of this bias on financial choices. By understanding the availability heuristic, investors can become more aware of how easily accessible information can influence their perceptions and decisions. Taking steps to avoid relying solely on readily available information and incorporating a broader range of data and analysis can lead to more rational and informed financial decision-making.